You are listening to the ESG and Coffee Podcast on investing, strategy, and sustainability, hosted by Graham Sinclair.
All this traditional finance theory, which says that non-financial data doesn't matter, wasn't an issue in the methodology that I was trained. They were not using ESG data, but it was long-term focused, and it really was about consistent long-term sustainable growth, whether it's cash flow or revenue or dividend. And so what we realized is that we could bring in non-financial data, specifically workforce and environmental data, to make the process, both the quant part and the fundamental part, even more robust. But the most important thing is we could bring it in on equal footing. So we could say that leadership diversity, gender and racial year over year is just as important as cash flow growth year over year. Not have a financial decision-making framework over here and a non-financial decision-making framework over here, which seemed to be the case, frankly, everywhere. We'd fire BlackRock like that day, but we wouldn't own them. So usually, but then Amgen, Amgen was one we thought that it was the only pharmaceutical company that wasn't gaming prices. And then they got pulled in front of Congress for gaming prices. So they got sold a few weeks later.
I'm pleased to invite to the ESG and Coffee Podcast my next guest, Liz Simmie, co-founder of Honeytree Investment Management based in Canada. I first met Liz on Twitter, #FinTwit. Please join the conversation. There's plenty of opinions. And I found Liz to be one of those plain speakers that I appreciate. She was not afraid to speak directly to what investment practitioners do well and how ESG is and is not meeting the moment, who's doing good work and who is greenwashing. One day we will enjoy a coffee together in one place, but for now we get to share digital moments like this. Like all my interviews, but especially this one, it is not boring. I'm sure you'll learn a lot. You'll come away with a few questions. At the end of the interview, I'll be back to give some highlights and takeaways, as well as something I missed. As always, ESG and Coffee is not investment advice, but please do listen to the experience of a human making investment happen, using all factors, including environmental, social, and governance factors in the investment process. Here is Liz Simmie. So today, in this episode in Season 1, I'm very pleased to welcome to the ESG and Coffee Podcast one of the originals making ESG positive investment happen, Liz Simmie, co-founder and CIO, Chief Investment Officer, at Honeytree Investment Management. Please check the episode note for more on Liz. She's on Twitter at Liz Simmie, where she describes herself as a co-founder of at Honeytree Invest, long-only concentrated responsible growth, elder millennial, subtweeting and doing real ESG and active management. And if you checked out her tweet today, you'll know exactly what I mean. And LinkedIn, she's described as advocate for investment industry transparency, strategic leadership, understanding impact, and making decisions based on data. Welcome, Liz Simmie.
Thank you for having me.
Great to have you here. Where in the world are you today?
I am in Toronto, in the east end of Toronto.
Excellent. In the fine country of Canada, yes?
Absolutely.
Nice. And first call here, if we were at your local coffee shop or cafe, what would I be ordering for you to drink?
In the summer, it'd be an iced Americano. In the winter, it might also be an iced Americano, but probably depending on the quality of the espresso and the place, it would probably be an Americano, but it could just be a doppio espresso.
Very good. A connoisseur. I enjoy that. Well, do you have your cup of coffee with you now? I have mine.
I do.
Nice. And my friendly mug from HIGHPOINTS.
Well, I'm drinking iced coffee now because I don't normally drink hot coffee in the afternoon, even when it's not hot outside.
Fair enough. We appreciate a disciplined investor. We'll unpack that more in part 3. Right. At the beginning, let's look back. I like to start at the beginning, looking back using Sir David Attenborough's superb Netflix documentary, Our Planet. He references 2 significant data points which illustrate the exponential changes happening on our planet in his lifetime. So I've asked you as my guest before the interview to check on 3 data points. I'm going to ask them and ask you just to reference what yours were. And the question is this: in the year you earned your first career paycheck, you don't have to tell us how much or when it was, unless you want to. Roughly, how much was each of these data points? World population.
Well, I started working very young, long before it was legal. And so my first paycheck was at about age 8 or 9. So I chose 1990.
Okay.
And the world population was 5.3 billion. The S&P was at 361, which I don't even understand or believe. And the parts per million was 354.
Got it. And for reference today, population 7.9 billion, S&P 500 around 3,890, and CO2 equivalent around 417 parts per million at the Hawaiian Volcano Observatory. Liz, Simmie, how does it feel to hear those data points and to reference back to when you started?
The cat has joined us. That's the one thing
Welcome,
I did not go before. I don't think the emissions numbers surprise us. I've always been a big fan of population geography, so I've always been a passionate observer and human growth and economic growth. And have we done anything since I was born or got my first paycheck? Not really. Yet we've talked about it a lot. That's kind of one of my, whether it's emissions or diversity. You saw the Morningstar piece that came out last week that was, we have not made a move in women portfolio managers in 20 years, right? And so we need to do a lot more is what this data says to keep everybody healthy.
Got it. Let's jump in then with some espresso shot questions. Short question, short answer, and then we've got our 3 deep dives coming. Right. So are you ready for your 5 espresso questions? Question 1. What is your earliest memory of investing?
Losing a bunch of money with my first investment in high school in the 2000 crash, which I talked about on the CityWire podcast.
Got it. What is your philosophy of investing in 1 sentence?
Responsible growth.
Nice. And what switched you on to ESG?
I always cared about it conceptually. I just didn't understand how it worked in security selection until I did. And that's kind of where Honeytree came from.
Wonderful. And how do you choose to define sustainable investment or investing with ESG factors in less than 30 words?
I wrote this down. Stakeholder governed, purpose-driven organizations outperform in the long term because their impact drives the bottom line.
Excellent. So read that for me again. That's very, very good.
Stakeholder governed, purpose-driven organizations outperform in the long run because their impact drives their bottom line.
Excellent. Right. Question 5. What is your biggest investing mistake so far?
Same thing, 2000, first money in the market, CityWire podcast. It taught me lots of stuff, like that markets go down a lot in the short term.
Was that a name or a strategy?
It was just I can't even remember if it was a global equity or US equity. I put $1,000, my first $1,000 into the market at whatever the top was. And then 8 months later, it was down to $600. And I that was my first and for a while, my only experience in the markets. And it taught me a lot.
Yep, that'll certainly hurt and that'll be burned into your memory. Fair enough. Let's move then to deep dive part 1 of 3, where we try and unpack recent topics, strategies, understand more about your approach and the shop. So if we, first of all, situating you, if we simplify the investment value chain into someone owns the money, someone advises on where to invest their money, someone's gathering the assets, someone's managing the assets, someone's analyzing investment options, someone's presenting data on investment securities and influencing the investment decision. Which would you say you do, and what does your firm do the most? So I'm trying to situate you in this investment value chain.
I would say we manage assets. That's our goal. We're an asset manager serving mostly institutional and advisors. That's how we're planning to build our business, as opposed to advisors, for example, who also advise on allocation, and consultants who advise on investment choices. So that's kind of where we sit, and that's what I do. That's what our team does is manage assets, manage strategies, equity strategies for others.
Got it. Okay. And a simple question I realized I wasn't asking before, so you're the first guest to have this question, because I like to be also practical, frankly. And the question is, how does one buy your investment or finance product or service?
We don't have a vehicle yet. So we started our firm purely as separate accounts. So those are currently available in Canada. And they will, at some point, probably around when this podcast is released, be available in the US. We may have a ETF available somewhere at some point in the next year. But for now, we're focused on the RIA base in Canada and eventually in the US, and institutions who are early adopters at new ESG strategies. We're very new. We're sub 2-year track record, which in the institutional world is, we're not even born yet. We don't have a vehicle that I can send you to, but you can find us by going to our website.
I really have found, I'm on record on this before around ETFs. I really, there's different types of ETFs now, the various varieties. So it's not just about tracking passive. There's active non-transparents, for example, there's thematics. I'm a big fan of them just because they make the entry point possible. So right now I'm working with my young son on getting him into the investment game with an allowance. And so we're looking through ETFs because it's a basket and it's low cost and it's transparent. And I'm a big fan of ETFs as the technology, as the vehicle. And I know it's difficult with some strategies and it won't suit everything, but I would argue any shop that possibly can absolutely must try and get an ETF up on the shelf. And I know that it's a very crowded space, can be, and you have to kind of fight for your shelf space. But absolutely, it's the right way to make it accessible to more people.
Yeah, and interestingly, in Canada, there's a lot of more active ETFs. We have different rules up here. So ETFs, even passive ones, are not required to disclose their daily positions. So we've had a lot more adoption of active ETFs, which drives the management fee down. So there will be a strategy available for 1.1% in a mutual fund, but it's 0.7 in an ETF up here that's active. And so that's why we believe, active ETFs have some issues in whether active or passive in terms of buying and ordering their bids and spreads and this kind of versus a mutual fund. But it really, I think what's happened in Canada is going to happen in the US, and folks will not even launch new funds that don't have an ETF vehicle attached or sleeve attached. So it'll be very fascinating to see how that changes the industry. And that we're just we have a strategy that we don't really mind if it's transparent, right? You can copy our strategy off of 13Fs because we don't change positions very often. So it's a very fascinating product dilemma.
Excellent. Good. And then I have to ask, and I know Paula, your colleague, has spoken about this before, and I'm curious to hear you explain it, the strap line that you have for Honeytree. And it's, quote, "At Honeytree, we invest like bees," unquote, which is just fun and great and smart marketing on your part. Liz, could you give us a few sentences on how you guys settled on the name? Were you flipping coins? Were you out in the orchard one day? How did you come on the name, and what does it mean to you?
We knew we needed a kind of tech forward, light, fun, fresh, non-stone gate black rock type name, because for basic branding principles, we could not be a gray gate like the rest of the investment industry. So in my background's actually market research before I came into the investment industry. So I care very deeply about this stuff. A lot of very large companies spend a lot of money trying to figure this stuff out. So that's what we needed, a simple word that was memorable, transferable, that gets caught in people's head, but when they see it, they think ESG. So that's what we were going for. And we started with Honeycomb, but there was a hedge fund in New York with the same name. And so we couldn't do that even though we were in Canada. So we actually spent like a whole weekend brainstorming because we wanted to keep the bee analogy somehow. We knew it was important because bees are like how our plants grow. They're woman-led. They're very systematic. We're kind of killing them, but we loved that analogy. So really, we kind of we did 4 days of ideation over a long weekend, and finally we were like, honey tree, and that's literally where it came from. So we did not spend $40,000 with a consultant to try to get the name, because we did not need that, but it matters a lot. And when you go to our website, the analogy that we've used, it's purposeful marketing, right? It's done for no other reason than to appeal to folks who are looking for investment management as done by the bees or focus. So it's really, we wanted to, so many asset management websites have so much information and so much stuff, and really wanted to be a little mysterious and simple. And so the story really worked well, and took a lot of convincing. We animated bees, like the second iteration of this, like because I built our website. The second iteration is going to have like flying bees. That's my goal. Wow. Even be cuter. So it matters a lot for branding.
Well, I'm going to push you then, and on account of having seen bees as part of a green rooftop, I think at Harvard Business School and definitely at International Finance Corporation down in DC, I'm going to need you to have a live stream to the official Honeytree bee colonies that you and Paula are running at some point. So
we are going to sponsor. There's a way that we can actually sponsor some of the local Toronto colonies. So we went to the group that does that. So we at some point we will send all our clients a little jar of honey from Toronto-based bees that we sponsor.
Wonderful. I was just enjoying the Science Friday podcast from NPR, and they're talking in Detroit, where they took a lot of the empty lots, and now there's community honeybee groups that are putting hives wherever they can. Excellent. Good. And there is no tree which is a honey tree, right? That's a made up word, or is there a tree called a honey tree? I could be wrong.
It's a Winnie the Pooh references it, I believe. That's where the reference comes from. We didn't get it from there, but that's what my husband, who was raised on Winnie the Pooh, his father's British, went straight there. So I think it is it's part of those stories. That's the only place it shows up, and then it's a couple random companies globally, like some daycare and other, but it's a made up.
Fair enough. We thank A.A. Milne for his contribution. Right, moving on then, in terms of the deep dive. Again, I'm just starting at the high level to understand the sharp, and part 2 we drill down, and part 3 we drill down more. And here I'm quoting off the website, I think. Honeytree Investment Management is a Toronto-based asset management firm focused on responsible growth. We build quantamental public market portfolios for institutional and select private investors looking for concentrated, high conviction strategies with full ESG integration. We are proud to live and work on the traditional territory of the Mississaugas of the Credit First Nation and the ancestral lands of the Haudenosaunee and the Huron-Wendat. I apologize for poor pronunciation. That's on me. First of all, I greatly respect the referencing to the First Peoples. That's first impressed me looking back at some work coming out of Australia, how they open public events, thanking the First Nations people. I've looked to do that. That particularly came up in the Arctic investing work I did at the Kennedy School when we were working on that. So respect to you for framing that. But why do you choose to use these 3 sentences to describe your shop?
our website doesn't have a lot of information. We did that purposefully. So this is, the first sentence is the first two sentences are really our brand positioning, why we're here, what we do, the products that we produce in as simple terms possible. Quantum mental is a little bit of a polarizing term, but it's what we.
So what can hold you on that? So I heard it the first time when you're being interviewed, and then I read it again, and I heard it, but I've got you live on the podcast. What do you mean by quantum mental, and what do people mean by quantum mental?
Apparently it was coined in 2000, and I spoke to the gentleman who coined it a couple of weeks ago, in 2005 or 6,
Okay.
Which is when the strategy that I was trained on was built. But the team that built it did not know that it was quantum mental. All quantum mental means is that we are neither pure fundamental nor pure quant. We're somewhere in between. We use both types of processes. I think a lot of strategies are in fact quantum mental. Some just do happen to be pure quant, and some just do have, but everybody else is somewhere on that spectrum. And so, in our process, which we'll go into, we use quant methods to get to a small consideration set very quickly, as opposed to our team covering 100 names, and we use the quant part to systematize our decision making to get it to a small area, and then we do a deep dive. So we're not a pure quant shop because we're not selling a systematic strategy out of our quant process, and we're not a pure deep dive only fundamental shop because we also use some quant processes. So that's kind of what it means. I was working on the product for years and even selling it at my old firm before an analyst was like, "You guys are quantum mental." And so then we just thought, well, that's a really good way to describe what we do, because we do not fit in the buckets, the traditional consultant or the traditional finance theory buckets of pure fundamental or pure quant. And I think that's important because it's why we can do what we do so small. It is what leads to outperformance. And it's also what allows the integration of non-financial data, ESG data, to work in our particular process.
Okay, and so let's talk a bit more on that process, and then I want to get to how you source your ESG data and then do your own analysis. So on the portfolio construction piece, this is described in the Honeytree Global Equity Investment Process document. You say our thesis of responsible growth is achieved by assessing ESG, non-financial and financial measures on equal footing throughout our process. And I think that's a fundamental design decision that you've taken on the process. When I'm working with clients as ESG architect, that's often the first point where we have like the big blow up / roadblock, because the ESG decision versus the financial decision, which goes first, how to sequence them, and then to try and fold them in to do them simultaneously is tremendously difficult and takes nuance and experience and so on. So could you unpack a little bit on that, how you operationalize doing them on equal footing through the process?
We lucked out because the only investment shop that I've ever worked for threw out most of traditional finance theory in how they built their portfolios. And their goal was to find the most consistently high dividend growing companies in the US. And they would be consistently high dividend growing because the governance and the management was of such high quality that they were able to grow consistently. So it was always about very long-term focused, pure fundamentals. So valuation was an important factor, didn't matter. All this traditional finance theory, which says that non-financial data doesn't matter, wasn't an issue in the methodology that I was trained. They were not using ESG data, right, but it was long-term focused, and it really was about consistent long-term sustainable growth, whether it's cash flow or revenue or dividend. And so what we realized is that we could bring in non-financial data, specifically workforce and environmental data, to make the process, both the quant part and the fundamental part, even more robust. But the most important thing is we could bring it in on equal footing. So we could say that Leadership diversity, gender and racial year over year is just as important as cash flow growth year over year. Not have a financial decision-making framework over here and a non-financial decision-making framework over here, which seemed to be the case, frankly, everywhere. Because we actually believe that we believe in stakeholder governance. We do not think shareholders are more important. And I'm happy to argue that on a governance framework with anybody. But most of the investment industry, most of the PMs out there don't believe that in security selection. They might believe it in the community. They might believe it in corporations and stuff. But the traditional investment framework, of which many portfolio managers are trained, causes stakeholder needs or stakeholders themselves to be secondary. And so this data, all this non-financial data is considered a secondary input. And that's why you see separate ESG teams at the world's leading ESG firms who are not involved in security selection. So we really thought it was important to use this data in security selection equally, because otherwise, what was the point? And that's kind of really what, we believe non-financial data is fundamental company data. Plain and simple. We believe a lot of ESG data is stupid, and we throw that all out and we look for the useful stuff. We don't care how many awards they've won. We don't care how many things they've signed that says they're not going to do bad stuff. We just look for evidence of change and innovation in the financials and non-financials.
Excellent. So that reminds me, I want to, in our third segment, I want to touch on performance attribution. You started a great conversation recently about that. But just to land this deep dive part one, your ESG data and analysis. So are you pulling feeds from vendors? Are you doing it yourself because you've got a concentrated portfolio? So you should have the bandwidth to do that. What is your approach to finding the ESG data and then making the analysis?
We use some open source data. So Carbon Disclosure Project, Glassdoor, so you can understand those are pretty simple pulls. We don't use a lot of the ESG data that is available from vendors for a couple reasons. We use different data sets, right? So we don't care just about emissions. I can get an emissions data set from anyone, but I can also just get it from the financials pretty easily. We want water use. We want waste. We want waste reuse. We want recycled inputs. None of this stuff is in any of the ESG data sets. It's really very emissions focused or CEO comp, the stuff that's already being reported. And in the workforce side, we started in 2018 only looking at diversity beyond gender, right? So we've always looked at racial diversity at board level, exec below. But none of that data was even available until last year. I think Refinitiv published the first manager level gender and racial diversity. And that data set was edited and missing most of our portfolio companies. So we're lucky because, we in our quant process, a lot of the stuff is financial or publicly available. Like we exclude dictatorships. That's pretty easy. We don't need a data set to exclude dictatorships. You just cut off all those companies. But when we get to our consideration set, which is only 45, all those companies are the leading reporters of this stuff in the world. So we're able to build semi-systematized data sets, quant ones and qual ones, from the company reporting and some open source data sets. And so until the vendors have the raw data that we can get from these companies, right, it's hard to find, again, it's gender diversity, especially if you look at any European based data sets or any of this. And we look at all of them, all the new ESG and impact and everything, but there's a big reporting lag. Like we have a couple of companies who don't look good on a lot of ESG scoring because they say they have no goals on diversity. They say they just haven't reported in the right place. They're in fact infinitely better at improving diversity or saving water than a lot of companies with higher ratings, but they're just not filling out the right forms because they don't have bigger marketing departments. So that's the big issue with a lot of the data sets is Canadian banks are really good at filling out forms. some retail and manufacturers in the US who actually pay more and do better for the world aren't as good as filling that out. So they get much lower scores. So we really try and, we're really trying to decide, are these companies stakeholder governed and purpose driven, which is very hard to do. There are very few companies out there run like that. They're not perfect, but they're trying to make the world better, and they make money because they're doing that.
Got it. I think it's a really important point, and that speaks to your qualitative advantage. And frankly, that's what clients should be paying any investment manager for, is that nuanced and that deep look, whether they use from a vendor or do it themselves or do a hybrid of the two. Let me then pick up one last comment in the deep dive part one here. You describe using 25 qualification criteria to create the consideration set, and you referenced it earlier. And then you look at growing financials, stakeholder-focused governance and innovation. You spoke about that a bit earlier. And specific inclusions such as fossil fuels, weapons, and tobacco. And then you go on in terms of your process. So something that's always stayed with me over the years was work when I was at KLD in Boston, one of the original ESG research and index shops. Got hoovered up by Risk Metrics and then MSCI. We once had a situation where we were examining tobacco exposure. And as soon as it comes to exclusions, the question is, well, how do you want us to measure it? Was often the challenge we had as the research shop back in the day. Client would say, we don't want X. We'd say, okay, X shows up in all these places. What exactly do you mean? And for example, if you recall the BlackRock CEO letter around thermal coal, it was exiting, above 25% of revenue, which still leaves a lot of revenue potentially coming from thermal coal. So when you look at fossil fuels, weapons, and tobacco, just how do you set the threshold?
That's a really good question that I think it's going to be really get very interesting over the next few years, especially as a lot of large endowments are going fossil fuel free. Like, what does fossil fuel free mean? Right. We're fossil fuel free, by the way, according to the traditional definition, which means we don't have fossil fuel extractive companies. Right. But all of our companies use a lot of fossil fuel. So I love saying that because it's kind of throwing us under the bus. But it is, it is. So exclusions, they're very interesting. So weapons, for example, a lot of traditional strategies only excluded weapons of mass destruction. Right. So he felt it was very important to exclude all weapons. Okay. But so we exclude all guns and stuff, in missiles, people who build literally things but we don't exclude surveillance involvement. Yeah. We don't exclude technology, military technology. We need military technology to save people who are drowning in the ocean. We need peacekeeping missions. So that line gets very interesting. And so what we'll tend to do, it's a little harder with some of the big techs when they're kind of the only option in the world, but we will look at what supplier number they are.
Okay.
We have Accenture in the portfolio, even though they're a supplier to the border prisons. Right. But they're supplier number 24. Right. And they're the only people who do what they do, but they've done a lot more work than a lot of tech companies on hiring Black people. Yeah. And so how do you balance those two measures?
And this is the reality, right? And I'm going to tease you. And when I look at one of your pitch decks soon, I need a slide there that deals with Space Force, okay? Just because we need the Netflix show and something from there, and then your satellite is watching for people floating in the ocean, and or something might happen. So
I need to watch Space Force. I have not watched Space Force, and I know I'll love it. I'm a space junkie. Apollo 13 is like my favorite movie of all time.
Yeah. I really enjoyed Michael Collins's autobiography as well. I greatly recommend it to you. Right, so let's wrap part one of the deep dive now with a classic question I like to ask, clarifying things. It's a look at a detailed performance indicator around carbon dioxide equivalence. So the question goes like this. What price for CO2 equivalent per ton does your firm use internally for your operations? And then what price for CO2 equivalent per ton is in your portfolios?
Okay, so our weighted average carbon intensity per $1 million sales is 45.9, which is about a quarter of the index. So we reduced about 75% of the emissions relative to the index. I mean, it is only 20 companies.
Mm-hmm.
We had there been no pandemic, we would have started tracking our travel emissions. But since neither of us have left our house in the past year, and that's something, it's really interesting. The price is all over the place in Canada. I don't know if you've looked at the carbon pricing. There's it steps up $10 or $15 a ton every 2 years or something up here. So we would use whatever the Canadian government was using at the time. We have not got there yet. So hopefully our integrated annual report next year will, we're not going to do a diversity report if it's just the two of us, because it's pretty straightforward. But that's something, we have to measure. And most of our companies are looking at it, and we think it's everything. It's commuting, it's the buildings, it's the shipping, it's the processing. It's so complex, and it's not just about, one of my big problems is our industry seems to be very obsessed with emissions from extractions and automobiles, and not from buildings, construction, commuting, shipping fruit from South America, all this kind of stuff.
Yeah.
Absolutely. So that's.
I mean, you've got a concentrated portfolio, so it's not unreasonable that you would have a relationship with them. You would ask them. So what I'm trying to track down through this question is I saw Swiss Re come out and say from 2025, they're going to have a shadow price of $100 a ton equivalent, which starts to get meaningful. And there's some other studies that say it should be way more than that. And so we all know that whatever is trading now is kind of artificially low price, right? Still effectively CO2 is free pollution. But so I'm curious, and my encouragement might be to you is, could you be asking your 45 companies, are you using a shadow price for internal deliberations? And I have heard some companies share this with investors, and the numbers range greatly. Like I've heard numbers around 10, numbers around 25, all the way up to triple digits.
No, just, I was trained in a shop that never met with management because it created a human bias, right? So you spend the whole weekend golfing with the management team, and then they call you when there's a problem and tell you not to sell. And we remove that bias. So that being said, we still do engagement. We are not big enough to matter very much, but it is, that goes in line. It's popping up in Canada, discussion of carbon price in the context of financial reporting. I haven't seen it that much in the US, and it's also because we have it's more standardized up here, right? I believe there's a lot in the US. It's very state dependent, so I think that's just one of those things that's going to, again, just become part of standardized reporting, right? As this data, as this environmental and workforce data gets standardized in the financials by the auditors, where carbon price risk and other types of environmental risks that are tied directly to financials will get standardized. So it'll be which price do you use, which jurisdiction. So it'll be very interesting. And it's, I think it's important nobody in the investment industry thinks, for the non-ESG world, thinks it's good to charge these companies for CO2. But that's just what's going to happen. We're going to get charged for plastic. We're going to get plastic banned because it kills people, right? And folks don't understand that the good companies are already thinking about this stuff. The good companies are already realizing that their bills are going up, right? So let's not just figure out how to pay those bills. Let's just outright reduce our emissions and our inputs, right? Let's kind of change. Let's start making electric vehicles, because then we don't have to keep buying credits. It's not, the BlackRock CIO who quit said that corporations don't play a role. And I disagree completely. I think governments play a huge role in regulations and pushing and change, but the idea that corporations don't play just as big a role in our future is ridiculous.
Yeah, I think that the points of view of that person, it's a much broader topic, and there were some misses there.
You are listening to the ESG and Coffee Podcast on Investing, Strategy and Sustainability. 您现在收听的是 ESG 和咖啡时间，投资策略和可持续发展。
All right, let's move on then to round 2 of your espresso shot questions. Are you ready, Les?
Yeah.
There we go. Question 1. What app are you most likely to be viewing on your smartphone while waiting in line?
That's a pretty silly question. Twitter.
Thank you. I borrowed it from the Wall Street Journal. And your answer is Instagram.
No, Twitter.
Very good. What book did you enjoy reading recently?
Seven Fallen Feathers by Tanya Talaga. It's about indigenous bias in policing in Thunder Bay, and a kind of a good summary of the disaster that what settlers in Canada did to indigenous people and kept on doing until extreme, well, and still do now. But it's a really, I mean, it's horrible, but it's a great story because it's about kids being murdered. But it's a highly recommended book for anybody interested in reconciliation in Canada or the US or globally.
Got it. Yeah, we'll include that in the show note. Thank you. What is the best kind of pie?
Pumpkin.
Really? Okay.
Yeah, it's the only one I'll eat. I don't like cooked fruit.
Fair enough. What is your favorite movie or on-screen moment that relates to the world of investing?
Definitely Moneyball.
Really? And what scene? The whole movie or a scene or something?
The whole entire thing. If we all managed portfolios like those teams were picked, we'd have a lot more outperformance of active management.
All right, we'll take that. And as an investment professional, what was your most meaningful success so far?
I mean, probably starting Honeytree, but I think our ability to talk about stakeholder governance in the context, kind of getting our story right around that, because that was always the original intent, but it takes time to figure out what you're really saying and selling. Yeah. And so I'm pretty proud that we've kind of landed on stakeholder governance, because it's always been one of my favorite topics, and we've been able to talk about security selection and performance in the context of that, and why if you don't take a stakeholder governance approach, using ESG data doesn't work. And that's kind of the big unspoken barrier issue that's happening in ESG, is all these folks are launching ESG products, but they don't believe in stakeholders. And so the execution misses.
Right. Good. Well, that's a great segue then to deep dive part 2 of 3. And let me open then with the classic of the sell discipline. So let me ask you just straight up, first of all, what is the sell discipline at your shop?
So companies can be sold for any reason, financial, non-financial, or combination of both. And it kind of falls out about a third financial only, a third non-financial only, and then a third do stupid stuff on both sides. Okay. So our sell discipline backs up entirely to our portfolio construction. So if a company broke one of the qualification requirements, which is very rare, but if their board diversity wasn't over 30% anymore, or their Glassdoor rating was down, or their dividend was cut, kind of our basic qualification criteria, it would be sold immediately. And the same thing happens in our deep dive, although it's a little less kind of hard cut, because there isn't a 15% minimum woman in leadership roles, and that data is annual anyways, right? So we have to be very cognizant of what's available on a non-annual basis, and what or intra-annual, and what's annual. So really, what we're trying to do in our deep dive is we've got 44, 45 companies depending on the year, and we're trying to pick the best 20. And so we have that 20. We run our consideration set once a year in the fall. So we'll be doing it again, I guess, for the 4th time in October. Mm-hmm. And that's where we get our consideration set from for the year. So with very few exceptions, we are only able to pick companies out of that group for the year. So that kind of removes a bunch of decisions and ideas. Yeah. There are circumstances where a company will come in during the year. Taiwan Semiconductors was one of those. After the Taiwanese election, we decided it wasn't a dictatorship. So it came in, but that's kind of the only example of something coming in. So once a company's in the consideration set, and once it makes it into the portfolio, then it's really up to three different things: quarterly financial performance being an issue, breaking one of the ESG rules, because we're not going to see quarterly decline in diversity and leadership or quarterly decline in water use. We're not at quarterly reporting that stuff yet. Adidas, for example, who we sold, and I think these are the notes later, they didn't have a bad year, but they didn't have a great year compared to some of their competitors financially, but they made a couple mistakes. They made one where they agreed to the government credit facility where they would then have to not pay a dividend, and then they were like, oh damn it, we better not do that. And they didn't need that kind of credit, so they're kind of stupid for doing that. But then their head of equity and inclusion said a bunch of non-equity and inclusive stuff and quit. And so those are examples of kind of things that add up to, let's say we owned BlackRock, which we would never own, and the CIO left and said ESG was BS. We'd fire BlackRock like that day, but we wouldn't own them. So usually, but then Amgen, Amgen was one, we thought that it was the only pharmaceutical company that wasn't gaming prices. And then they got pulled in front of Congress for gaming prices. So they got sold a few weeks later. And that would have happened even if they were the best performing fundamental company in our portfolio. So that's kind of how it's really, are they breaking any of our rules? Are they falling down quarterly financially? There was some debt capacity issues last year, given who knew what was going to happen. So we're really, I don't want to say we're flexible. We'll fire a company for anything. But we think they're all as important, right? So there is not some cell discipline based purely on a financial model. It is based entirely on our portfolio construction model. And that's what we've done. We set thresholds in our deep dive across all our measures annually. And so we're really kind of watching on the measures that we can get quarterly data, if there's any negative changes there. And we have a bench of companies. It's not the whole 25 or 24 other companies, but we have a short list of companies that can go in if we need to fire somebody. But I don't want to say we don't ever want to sell and buy companies, but we have, I think, is it 12 of the 20 are original from May 6th, 2019. Okay. And arguably, some of the other ones were, we like to think of this as a learning experience. If it wasn't a learning experience, I don't think we would be doing our job, but it is, we're very long-term. At the same time, we have no problem firing companies because we've got some potential replacements. So we try and keep it very simple.
Okay. And so let me unpack it's interesting that you mentioned the learning, and you're quite right. Active managers, there's a huge, a large fundamental aspect to what you're doing. You choose not to interact directly with the company to reduce that human bias. You described that earlier. When and how would you have a situation where you should have, well, according to your cell discipline, you were going to fire that company, but then you decide this is a learning moment and they can work through this? So would there ever be a situation where, for ESG reasons, financial reasons, what have you, Adidas, what would Adidas have done differently where you would have sat together as the investing committee and said, this is a teachable moment, we will keep walking on with this holding?
I mean, all our companies do stupid stuff. And it's really how they respond to it, right? In their disclosure of it, and their acknowledgement of issues. So I think we weren't seeing much learning on the bond thing separate. We want, Adidas has a different set of challenges than Nike, right? Adidas is European. Racial equity, racial diversity, even though that's, we'll call it a core aspect of their client base, is different. It's not as serious a thing. And what we would have expected from a company like Adidas is for them to do some more stumbling and figuring stuff out instead of kind of just saying, well, it's not that important. We want, and you go back to Nike, you look at Nike's my favorite. We have Nike in the portfolio. Still, they've made so many mistakes across all parts of the business, whereas the pregnant athletes losing their contracts, the guy doing performance enhancing stuff at the thing that when it came out, they said, oh yeah, you're right. We're bad. Let's change this stuff. Right. And so we're really looking for companies because again, even the most like impactful wind farms in the world still have negative externalities. Right. And so it's what are they doing? What are they doing to address them? And so we were happy to sit there and go, are they going to, this stuff happened with Adidas earlier in the year, right? This was May and July, and we didn't sell them till October, but it was clear that there's a bit of a governance hole there, and it's not a risk that we were comfortable taking. And we had some other options as we did
And that's obviously when there's thinner margins where you do have the plan B, the other stock that you could be in. It's always it remains curious to me that Adidas haven't won better at that. I mean, they were the brand of Bob Marley. I don't know if you've seen some of those old 1970s concerts. I have recently. So let me quote then, just landing then on, not to beat up on Adidas, but it is a worked example. So you said in your annual letter to your investors, companies reacted poorly under stress. This is the case for Adidas, which you sold in the fall, as you just said. They made numerous fumbles, right? So when is their redemption? Maybe to quote Bob Marley, when is their redemption song get sung, and when would you look at them again?
That's a really interesting question. I've been thinking about that lately because we obviously have a group of companies that we've fired from the portfolio, and some have no redemption ever, but others do have some potential of redemption. Now, I would say the ones who were fired purely for financial reasons, you would think that they would have a higher chance of redemption. At the same time, I think we take the stuff just as seriously, whether it's financial or non-financial. So, our companies that we keep on holding do stupid stuff. It's just the scale of stupidness and the speed of disclosure that we're looking at. So, and we also don't take a lot of good companies that are really well known as high ESG because we don't fully believe that they're truly committed to the long term. So basically by firing Amgen and Adidas for those reasons, we're saying in the near and middle term, we're not super confident about their stakeholder governance, the quality of their stakeholder governance. So it'd be hard for them specifically to get back in. Kind of like we can't consider somebody who's cut their dividend, like they're off for 5 years.
So what about a situation, VW, Wells Fargo, Boeing, where they cut the CEO or they cut some board members? In my view, when I'm working with clients figuring out the ESG architecture, we're developing portfolio strategies, I'm always strong on culture. Explain to me, where does culture show up in your investment process? How can we build it for you and according to your investment philosophy as a shop? So would that be a strong signal for you to have a good hard look at it? Or even then you say, no, this is years away?
I love CEOs being fired because it shows that the board is functional. I'm not sure everybody agrees with me on that, but the board's role is to fire CEOs and hire CEOs. And they don't have that much of a job beyond that. And they don't do a very good job of it very often. So in 2018, when we ran our consideration set, 3 of the 40, I can't remember, it was 43 or 44 companies, 3 of them had fired their CEO in the past 6 months. So we're actually happier with CEO firing than we are with CEO retiring, right? And so it's not, so culture is everything. Culture is stakeholder governance.
Yeah.
Culture is stakeholder engagement. Culture is retention. Culture is how people drive the bottom line, who are employees or customers or you name it. So it's when I say stakeholder governance, a big part of that is culture, because you can have a big company that makes a lot of money and has a whole bunch of employees, but they have no engaged stakeholders. They have high turnover. They have to pay more. They don't keep associates. They can't keep any women or racially diverse folks in any roles because the environments are so toxic. And so they struggle with this stuff. And the companies that we own don't, because they think they understand how their work on this drives the bottom line. They're not doing it for token to look good, like BlackRock's bond announcement today, or their lending facility where they've tied it to they're totally screwed on that, by the way. But it's really, you just look at all the companies who wouldn't release their diversity data and had to have BlackRock or whoever be like, or not BlackRock, but, the activist shareholders and the big teams be like, no, you have to release this. Those companies don't have good culture. This stuff's being standardized for 3 or 4 years now. You have the data. Right. People don't. So and culture, culture matters to the bottom line. It's not like this little thing. It's what drives purpose. It's what drives engagement at good companies that are sustainably growing for the long term.
Got it. So let's land deep dive 2, and we're running a bit long here, but we'll make that time up in our last section. But let's land deep dive 2 here with the greenwashing question. So do you agree that greenwashing is real, and how does it hurt the work that you do?
I think greenwashing and pinkwashing, which I use to generalize on the diversity side of things, I think they'll help us, because I think everybody's going to realize pretty soon that a lot of the products out there are what they consider greenwashed. Mm-hmm. And I don't think it actually has to do with any particular type of company in any sector on the greenwashing or the pinkwashing. I think what's happened is most folks, whether they're in investing or not, can look at an ESG strategy or an ETF or an impact fund or whatever, and they go, well, why is Apple, Facebook, Microsoft, Amazon, J&J, Nestle, and why are they all there? How are they all good? How are they all making the world better? And so it's not a particular banks are bad, or tech is bad, or consumer packaged goods is bad, or whatever. If these guys are trying to sell companies impacting the world or doing sustainable stuff, I'm pretty sure these are not the 10 most responsible. So it's really my understanding of greenwashing and the disconnect comes from everybody, whether they don't believe in ESG or they do believe in ESG, seeing this disconnect in the products. So it's and you just, again, all the BlackRock products, I'm sorry to pick on them, but they're just the easiest because of all the media that they've got. The people buying ESG products at BlackRock want to believe that the investment team thinks this stuff is tied to the bottom line. So when they hear that this is all BS, that they're just, it's like, of course this is greenwashing. This is what everybody's been saying, but we thought these guys were doing better. So I think the investment industry does lots of stuff like this, not related to ESG, right? Whether it's fees or different types, and so much conflict of interest, and we're not very good at looking good as an industry. Right. And so this is just opportunism and marketing, and folks not really knowing what to do turned into like a really hilarious marketing opportunity for us. And so that's
I like the competitive advantage you see coming.
You're listening to the ESG and Coffee Podcast, hosted by Graham Sinclair. Sie hören den ESG and Coffee Podcast. Ihr Gastgeber ist Graham Sinclair.
Right, so let's go to fast espresso shot questions, group 3. You ready?
Yep.
Here we go. Do you have a favorite type of tree, and what is it? And you cannot say honey tree.
I like birch trees.
What one book on investing would you recommend?
Dark Age Ahead by Jane Jacobs. The Death and Life of Great American Cities by Jane Jacobs, which is not an investing book. I don't really believe much in reading investment books. I like reading history and data books. And if you have not read The Death and Life of the Great American City, and you're in investing, or especially ESG, it's probably probably more important than any course I took in college.
Wow. That reminds me, Julie Hudson was one of the originals at UBS, framing their ESG work in the aughts. She had done some early important work around spatial development. Right. How is your own retirement fund invested?
100% in Honeytree stuff.
There we go. That's called alignment. What would your advice to your 17-year-old self be today?
I mean, I wouldn't have been able to start Honeytree if I didn't make all the career mistakes that I did. So it wouldn't be career. It would be drink more water and eat more vegetables. I think most of us could use that advice as we get older and our bodies don't work as well as they used to.
I see you saying that at a commencement speech one day. What is your advice to people seeking to enter the field of ESG investment and finance tomorrow?
I tell this to every young or not so young person who asks me this. I love meeting people and kind of talking about the careers in this industry because it's all about networking. Half the jobs aren't posted. You need to go find people. You need to go meet people. You need to get on radars because we need to change our hiring. But while it's not changing anytime soon, just like in the big four and asset management and ESG, you're not going to get a job on a list of 500 applicants because the 20 of those folks are already known to the associates or the senior folks. It doesn't, you do not need to be a member of the golf club with them. That's not what it is. But you need to be conscious of how decisions get made, which is, hey, we need this person. We could post a job and do all this stuff, but hey, we know this other person. Why don't we have them in and see? So you really need to think differently, and way beyond, and Honeytree is not hiring yet. I get requests like many times a week. But I find firms that you want to work for and, connect with them. And eventually, you'll at least know when they post a job. That's the other thing, right?
Yeah, sure. That's good advice. Right, for deep dive part 3, just mindful of we tied on time, we're just going to focus on the engagement piece. You've spoken about it in different ways already, but let's unpack more from your letter. The year Stakeholder Governance mattered. You published that on the 20th of January 2021 to your investors. And there are 2 parts here. One, you dealt with Illinois Toolworks, ITW, and the other one was Edwards Life Sciences. And could you just unpack a bit on the engagement that you took? Who did the engagement? Was it you and Paula, your colleague? Or how did those conversations go? These are names in your portfolio, so you chose to engage with them. So could you talk a bit about Illinois Toolworks and Edwards Life Sciences?
Yeah, I mean, our engagement philosophy is we don't want to hold companies. We need to micromanage. That being said, they can all improve in various aspects. So our engagement is focused mostly around reporting, and then the big gaping kind of areas, depending on which company it is. In Illinois Toolworks, I use them all of the time. If you look at any ESG data set, they get really low scores on diversity because they don't report it anywhere. Yet their year over year women in leadership and racial diversity in leadership is off the charts. I think I just saw their new report yesterday, and they're past 25% women in leadership, up from 12% 4 years ago. And I think they're getting close to 20% racial diversity in leadership. They are an industrial company north of Chicago. They're not some fancy equity and inclusion, San Francisco or New York or company. They have no reason to do it. And so when these guys are leaders, so we're not engaging with them on improving diversity. And each company has, there's certain themes too that we'll focus on in engagement. But it really depends on the company, and if they're doing something that is really bad, we're more likely to sell them than engage with them.
Okay.
That's kind of that. And Edwards Life Sciences is a pretty new addition too. But it's they didn't need engagement to figure out this parental leave issue, and they're the first one we've seen.
Okay.
And I think it's important to mention because lack of equity in parental leaves, especially when they're offered equally to men and women, is a big problem for diversity, especially at senior levels. And you see that in banks in Canada and the US, all the guys have 3-4 months or more paid parental leave, but they won't take it. And unless the company changes their culture to make it okay, it'll always be seen as if kids are my problem and not my husband. So we could engage on that. At the same time, we want to hold the companies that are doing it on their own, figuring it out.
Got it. And I can't ask a Canadian investment questions without asking, in what way does ice hockey show up in your portfolio, ma'am?
I don't know.
Pick that up in our second interview a year from now, but I need to hear ice hockey come through in some way. I guess life sciences could be like some first aid healthcare treatment option for the players.
Heart parts, they do heart valves. I can't think. I'm not a big hockey fan. I'm on baseball.
Okay, we can edit that out. Don't worry. So let's wrap deep dive part 3 on ESG in 100 moments. So I'm writing this book. I've been encouraged to write this book on the history of ESG in 100 moments. That's accessible, kind of not quite a coffee table book, but not a thick academic piece. In your experience, if you were to pick up this book and you were to page through it, and then you would suddenly go, wait, hang on, Graham. You do not have my favorite moment or my most significant moment in ESG in your 100. What would that 100, that one moment be that should absolutely be in the top 100 moments?
I mean, the easiest answer for me, because I've kind of spent the last year or so saying that this was a problem, was when the CIO of the largest ESG provider left and said ESG was BS, because I think it blew off this kind of perceived, I thought they were trying, sort of. I mean, I knew that they weren't, because no asset managers really care about this stuff, but I thought they were trying harder than some of the other ones. And I think a lot of other folks, whether they're retail clients or institutional, did too, because of Larry's leadership on this. But I think it really just exposed, like, very clearly the separation between financials and non-financials. And the problem is the end client doesn't believe they should be separated, right? And the end client is slowly kind of trying to piece together what is really ESG. And the good news is, just signing a bunch of policies and pretending you care and it isn't going to cut it, right? And folks who want to invest in this stuff want a CIO who believes in it. And so that, I think, is going to change how the end client sees the industry. Because I think that the doubt was there, but now the evidence is, and this is, it's not, I pick on BlackRock, but this is a lot of the Canadian ESG firms have the same issue, right? So
I think I understand your point. Yeah, thank you.
You're listening to the ESG and Coffee Podcast, hosted by Graham Sinclair. Вы слушаете ESG and Coffee Podcast. С вами Graham Sinclair.
Right, let's come into land then with the fast espresso shot questions for our last chance. These are a mix up of the Proust questionnaire and the Bernard Pivot version from inside the actor's studio. 9 questions. You ready? Here we go. What is your favorite word?
That is a tough one.
That's
I
2
would
words.
say, canoe.
Oh, nice. What is your least favorite word?
Probably anything angry, anything negative. I really only like positive stuff.
Got it. What profession other than your own would you like to attempt?
Definitely chef.
What profession other than your own would you not like to attempt?
Anything related to a bureaucracy or a large corporation.
What attribute does an excellent investor have?
The ability to manage emotions.
Which living person do you most admire?
This is a cop-out, but Tony Bourdain, because he's dead. But he's my favorite human of all time.
Okay. We'll include a link to his bio in the show notes. Which talent would you most like to have?
Remembering people's names.
Oh, yeah, that's a good one. What do you consider your greatest achievement?
Probably having kids. It was a lot of work.
What is your idea of perfect happiness?
I'm a big Hemingway fan. For not, but specifically for sitting on a patio drinking something strong and kind of looking in a town and just that pace. So yeah, that's kind of my happy place, is sitting with my husband on a patio somewhere in the world where our kids are not, and pretending we're voyeurs and just relaxing.
There you go. I have an idea that you should come with me next time I'm back in South Africa and we enjoy a sunset looking at some animals just in that situation. Right. Before we end with the Goldilocks question, an opportunity to talk about an action question and then to check with you. So, action question. What action do you want our audience to take tomorrow, wherever they are along the investment chain, whether they're big or small? What action would you like them to take?
I'd like you to question everything that anybody says about ESG or impact, and don't take, especially if it's an investment firm like mine trying to sell to you, don't take a bunch of slides and a couple, signing some things saying that they actually believe them. Get them to explain it. Dig into their research, dig into how their teams are structured, dig into their decision making. It's possible. The manager research folks are doing it. Some of the institutions and allocators are getting smarter about it, but it's easy. Ask them how they use gender equity or racial equity data in security selection.
That sounds like an action. So good recommendation. Thank you. So into the Goldilocks question then. My final question. One share of Tesla, TSLA, was trading at yesterday's close on NASDAQ at $691 and had a good day. Is that too high, too low, or just right, and why?
We don't believe in price targets, and we exclude companies who settle with the SEC on charges. So I actually have no opinion.
Wow, controversial answer. Thank you. So you've been a fine guest, Liz Simmie, co-founder and CIO of Honeytree Investment Management. You're one of the originals. Thank you for the work that you do every day to make investment happen in a new direction. I like to say the investments you make become the world that we all live in. So thank you so much for trying to make it better. And thank you so much for joining me on the ESG and Coffee podcast.
Thank you for having me.
And now we keep the tape rolling to hear from Graham and his guest as they reflect on their discussion and anything they wanted to add.
Is there anything that you feel we should have covered or should have covered differently? Anything you'd like to add?
We didn't talk about impact in ESG.
Okay, go ahead.
For folks who traditionally, public markets, ESG strategies, according to some groups, sit outside of the sphere of impact. impact investing is done with intention, and is easier to, let's say, measure and see in private market investments, like a windmill farm. A windmill farm is creating all renewable energy, even though it takes like metal and emissions to build it. It's really easy to see why investing directly in, renewable energy, or in a fund that's purely renewable energy, is impact. It's not that it's more impactful than something else. It's just clear. It's clear to the end investor. It's clear to the manager. It's clear to everybody involved. What we're trying to make the argument for is large companies play a huge impact in pay equity, in minimum wage, in tax, in a whole bunch of stuff, in water use, and plastic, and all these things that they, on a much larger scale than smaller private investments. And so to say that they're not making, that they don't have a giant negative impact to be remediated, or not making a giant impact positively on all their stakeholders, we think is flawed, right? Is it different than a private direct investment in something that is totally green? Sure. But, as these companies shift to renewables, as these companies shift to, recycled plastic or seaweed-free materials, they are going to make a huge impact. As they pay more women in leadership roles, as they hire more Black folks in leadership roles, they will make a bigger impact on the local communities and the stakeholders than just, what is considered pure impact right now. It is different. At the same time, we look at it as negative externalities. Everybody has negative externalities, no matter how impactful, and how are all the companies and governments in the world reducing those negative externalities. And so that's how we think of impact, which then allows us to make the argument that, these companies, even though they're large cap public markets companies, are driving impact. This is an impact investment, even though it's not traditional impact.
I see. And exploring that a little bit further, one thing that's come up more recently is this question of, and Paul Pullman himself has said it. He was at the Kennedy School in 2019. I had a conversation with him. This is after he'd exited as CEO of Unilever. He was making the case for companies need to pay their fair share of taxes if you want cities that work and schools that work and people to, build a useful society. And now there's a conversation that's happening. Well, how can there be so many companies that aren't paying federal taxes? And maybe there needs to be a minimum threshold that companies are all chipping in certain ways. Do you have any view on companies need to be paying a fair share of tax, and the system of how they're able to shield from taxes needs to be looked at differently?
Yeah, I think my biggest problem in taxes is companies actively lobbying on taxes. So when you look at the big tech, the big West Coast tech, they spend half of their lobbying dollars, so $5 to $10 to $20 million a year, on specifically taxes. So they're not even lobbying about privacy or technology or anything. They're lobbying about taxes. Now, I believe that there are lots of reasonable accounting reasons why one would have a lower tax rate for a US-based company. And there's a couple international reasons. They also, got super reduced 2 years ago because of who was in power in the government. What are you going to do? Say, no, we want to pay 20% extra tax this year. It doesn't work that way. But so I am a big, Paul Pullman, I would agree with completely. And this is what we're looking for. We're looking for companies that will stand up when there's election, when there's an issue with democracy, who will stand up and not, who are not fighting minimum wage laws. There's a lot of highly rated ESG companies, especially in Canada, who fight raises of minimum wage. Okay. There's nothing, I'd rather somebody get tax reductions than being actively lobbying the government to stop an increase from $13 to $14 an hour of minimum wage. Right. And so it's so complicated. At the same time, it's really the minimums and the requirements for the, other than like the wire cards of the world, most of these companies, even if they have low taxes, are following rules. How stupid the rules are is a different story, depending on which jurisdiction you're in. And there's issues too with the US repatriation, like I think Biden's going to up the corporate tax and then they're going to try and smooth it. As long as there's jurisdictions to stuff money somewhere, somebody's going to figure it out. But it does come down to public stance on this, even if it's a changed public stance, right? Like people can grow and learn, and it really is. But you can see it's government and corporate, right? We can't just pretend that it's all government if all these corporations are spending all this money trying to fight changes.
Right. I hope you agree with me that was a fine interview with Liz Simmie of Honeytree Investment Management. Here's 4 high points that I took away. Maybe you did too. Firstly, context is everything in life and in investment. I respect the way Honeytree Investment is clear on the historical context of where they base their operations. The website stating plainly, quote, "We are proud to live, work and play on the traditional territory of the Mississaugas of the Credit First Nation and the ancestral lands of the Haudenosaunee and the Huron-Wendat," unquote. In many ways, the Canadian investment industry is doing a better job than most jurisdictions in recognizing the history of how the economy was built and at what price to whom, and looking for routes to include those historically excluded. See in Canada the Reconciliation and Responsible Investment Initiative, which is a partnership between NATOA, N-A-T-O-A, which is a charity supporting Indigenous peoples of Canada, and SHARE, which is the leading not-for-profit organization on responsible investment services, research, and education based in Vancouver. When you are a new investment firm in the 21st century, you too may have the opportunity to write a new story, facing all the facts of history. Honeytree Investment Management has taken up that opportunity. Secondly, let's talk about diversity. You can feel most shrink when Liz talks candidly about the poor state of diversity in the investment profession. Her 2020 article, quote, "How bad is diversity in the investment management industry," unquote, for Benefits and Pensions Monitor, will make most financial firms pause and many feel uncomfortable. The quarterly report has a story unusual for a firm which is one portfolio of 45 names. I quote, "Measurable impact from companies in our global equity strategy. Note that they all impact both stakeholders and the bottom line. Illinois Toolworks, ITW, has made diversity an organizational priority and they have been able to execute on it. In the 2 charts on the right, we can see their year-over-year change in ethnic and gender diversity in leadership roles. This level of organizational change creates real impact on the firm, employees, and communities," unquote. I didn't expect it, but somewhere I found myself quoting Bob Marley's Redemption song when we were talking about Adidas, which had enjoyed the hairdryer treatment in the Honeytree Annual Letter to Investors 2020. Quote, "Companies reacted poorly under stress. This was the case for Adidas, which was sold in the fall. Adidas made numerous fumbles in 2020, not limited to having to step back from a government debt offering because it would limit their dividend, and having their head of diversity resign for lack of understanding of inclusion," unquote. Thirdly, Twitter is where the conversation is at. Liz laughed when I asked her, "What app are you most likely to be on?" Because we both know her voice is clear, loud, and present on that free website. See, for example, her calling on colleagues in the investment profession to see the discrimination some months after our interview in September 2021. Quote, "So while tons of folks care and even know how to change the industry, they are not on positions of power. And the folks that are, 1, don't fully recognize the issues, and 2, don't know what to do about them," unquote. Twitter remains a forum where one may engage across distance with experts if one is able to and remembers to dodge the trolls, the bots, and the imposters. Personally, I need Liz to question her ranking pumpkin pie as the best kind of pie, but her idea of perfect happiness seems good around about now as I stare out at the snow falling here. And fourthly, question everything. Liz's encouragement is not to believe whatever promises are made or count whatever initiatives investment firms are signed up to. She clearly has experienced that asset gathering by investment firms is marketing. And where there's marketing, there may be BS. Unless the firm can show you what to do or what they do and how. Liz explains how, quote, stakeholder governance, unquote, is the business approach that underpins the Honeytree Investment Management investment philosophy, which happens before the security selection deep dive work begins. Ask the investment firms how they use gender diversity in security selection process was a pointed question. Liz's answer to the Goldilocks question on that day's price of Tesla, that Honeytree Investment does not invest in firms that settle with the SEC, is direct and controversial. Elon Musk settled SEC fraud charges in 2018. This is the first episode where guest talks jargon, and I try to have Liz explain what quantamental means, as in the Honeytree Global Equity Investment Process 2021. Quote, quantamental approach uses quantitative tools alongside a fundamental deep dive to find companies who are stakeholder governed, long-term focused, and growing consistently. The companies we hold make a net positive impact on the world and outperform as a result of their purpose-driven, stakeholder-focused growth. Well, those are my 4 high points. I hope you, like me, really enjoyed that episode and think it stacks up really neatly next to the previous 7, and I look forward to being back with episode 9. As always, please follow us at ESG and Coffee on Twitter, and send your feedback to me, Graham Sinclair, at ESG Architect, and don't be afraid to give us a 5-star review and share it with your friends. Thank you.
We hope you enjoyed the interview with one of the originals in investing, strategy, and sustainability. Please subscribe on your favorite podcasting platform or on YouTube and leave a 5-star review. Bad reviews you can send to Graham Sinclair at ESG Architect. All the details are in the show notes. And for news of our next guests, follow us on Twitter or Instagram at ESG and Coffee. Do you know an impressive human we should absolutely interview on investment strategy and sustainability? Please let us know on Twitter at ESG and Coffee. Our producer is Kat Farquharson on Twitter at Kat Farquharson, and original music by Aaron Bonney on Twitter at Aaron Bonney Music. And of course, this podcast is for your enlightenment, not investment advice. Do your own research.
You have been listening to the ESG and Coffee Podcast on investing, strategy, and sustainability, hosted by Graham Sinclair.